Jump right in here. First question, it's actually two questions tied into one. First from CF, can you comment on Mike Green's recent Endgame podcast with Grant, specifically around the implications of negative rates and the 10-year going negative? Unfortunately, I haven't listened to it yet, and so it's on my list of things to listen to in the coming days. I got another question along the same lines, though, from Tariq. Do I anticipate negative interest rates in 2021? And the answer that I would say to both of those is I don't anticipate the Fed ever taking rates negative in the United States. And the reason I think that is because unlike in Japan, unlike in Europe, the United States has a significant amount of its treasury bonds as the FX reserves globally. In other words, treasury bonds, there's $7 to $10 trillion in treasury bonds sitting in FX reserves globally. These are effectively the savings bonds that foreigners reinvested dollars into. These are basically serving as their gold reserves. That's how the system worked. The treasury bond was the primary reserve asset in the aftermath of 1971. If rates go negative beyond a certain point, and really I think for any beyond a significant point, I think is basically at all. If rates go negative in the United States, what that amounts to is foreigners having money that they earned in the past being taken out of their pocket by that negative rate. And so I think if rates were to go negative, it's effectively a massive political shift. It is effectively the end of the dollar's reserve status as structured in the aftermath of 1971. So you would basically be, I think negative rates in the United States begins to accelerate a move from treasury bonds to gold, a move that, as we've talked about a number of times, central banks have been doing since 2013. So I think it's important to note that any move by the Fed to negative rates is effectively a move against the dollar. And as such, I would expect they would need permission from Treasury, since the dollar has historically been the purview of Treasury. So I need to fully listen to the Mike Green interview with Grant and Bill Fleckenstein. I haven't had the opportunity to do so yet. So with my apologies if that I haven't done so, those two questions as it relates to U.S. negative rates, those are our thoughts as they stand at this moment. Second question from AS. As someone who is super bullish gold, why are you not equally as bullish on oil? For me, it's because we're seeing the marginal barrel of oil priced in currencies other than dollars, whether it's euros, whether it's yuan. Again, it doesn't have to be a lot of oil priced in euro or yuan, just the marginal barrel, because as the CFO of one of the biggest commodity trading houses in the world told me 10, 15 years ago, in commodities, the marginal ton prices the whole. In other words, it's that last barrel of oil that sets the price for all the other barrels. And so, and we saw this a few months ago when oil went to negative prices. There was nowhere to store the last barrel of oil, and oil prices went negative. So, trying to get rid of that last barrel of oil. With that in mind, if the marginal barrel of oil, if that last barrel of oil is priced in euro or priced in yuan, the implication of that is straightforward, which is that if the dollar is rising against the euro and yuan, it's going to be hard for the price of oil to rise against the dollar. And so basically, I'm not as bullish on oil given how bullish I am on gold, simply because for oil to rise in a multi-currency oil system, you need either that multi-currency oil system to end, or you need the dollar to fall against the other currencies in which oil is being priced, primarily the euro and the yuan. So that's how I stand there. From OM, Luke, I know you're a dollar bear, but with so much uncertainty, don't you think it's still wise to keep some dry powder to take advantage of potential opportunities? I'm already heavy in precious metals and miners. Is it too risky to keep 20% net worth in cash right now? In a word, no, I don't think it is. I think our view is that we're not selling any equities, but where we want to see a pullback before we would add to equities. So far, that hasn't worked in recent weeks on net, I would say. But I think given where we stand in terms of the uncertainty with COVID, potential re-shutdown of the economy, etc. I think it's ultimately a personal decision of comfort, but I always like having some cash around. I don't think that's a crazy thought. And then from HY, here's a topic you should discuss. Why is everyone talking about yield curve control when the curve is barely steepened? It doesn't seem necessary for the Fed to even consider yield curve control if the bond market isn't concerned about inflation, particularly on the long end. I think they're talking about it because I think they understand the epic supply-demand mismatch that is on the come. There is not enough private sector balance sheet to finance deficits in the United States, the prospective deficits in the United States. And so I think they understand that they are going to have to, and so they are trying to basically jawbone that. This is made all the more true by what the White House recently called its new great power competition with China. The last great power competition we had was with the Soviets. Before that, it was with the Germans and the Japanese. And great power competitions are very, very expensive. And they also tend not to be financed by your adversaries in said great power competitions. And so the Fed's going to have to finance it. The Fed's going to have to finance the deficits we have as a result of COVID. The Fed's going to have to finance the $200 trillion we owe baby boomers and via their entitlements over time, baby boomers and the generations that follow. And so I think the Fed just is trying to set the table for people to understand how this process is going to be managed. So ultimately, I think it is very bullish for gold, yield curve control that is. I think it's bullish for risk assets. I think it's bearish for the dollar. No one has more yield curve to control than the U.S., given the amount of deficits the U.S. has. So with that being said, that is it for tonight. I thank everybody for joining me. As always, if you like these updates, please check out FFTT-LLC.com to check out ways you can subscribe to our Tree Rings product. It's a weekly 10 most interesting things list. Gotten a lot of great feedback from clients, and I look forward to chatting with all of you soon. Everybody have a great week. Stay safe out there, and we'll talk soon. Take care, everybody.